Leverage magnifies your gains. But here's the part that too many people overlook. Leverage magnifies your losses with equal force. If that house drops in price to $450,000 and you sell immediately, you've lost 50% of your investment, and the bank still expects you to repay the full $400,000 loan. Leverage doesn't care which direction the market moves. Hi, I'm Andy Temte, and welcome to Money Lessons. Join me every Saturday morning for bite-sized lessons that are designed to improve financial literacy around the world. Today is May the 2nd, 2026. Last week, we wrapped up our exploration of preferred stock and noted where we'd be headed next, which is leverage and margin, or what happens when investors borrow money to buy stocks. I want to start with a simple idea that frames everything that we will cover today. Leverage is a tool, and like any tool, it amplifies the skill of the person using it. A disciplined investor can use leverage to enhance returns, but for someone chasing a get-rich-quick scheme without fully understanding the risks, leverage can turn a bad decision into a financial catastrophe. The difference between those two outcomes almost always comes down to understanding, and that's what I want to give to you today. Now, at its core, leverage means using borrowed money to control more than you could with your own cash. 2 weeks ago, we defined capital structure as the mix of debt and equity that a company uses to finance itself. Leverage is what happens when investors apply that same principle to their own portfolios. So, spoiler alert, just like a company, you as an individual or a family have a capital structure. Now, here's an everyday example that most of us already understand. When you buy a house with a mortgage, you are using leverage. Let's say you put $100,000 down on a $500,000 house and borrow the other $400,000. If the house price rises to $550,000 and you sell right away, you've made $50,000 on a $100,000 investment, which is a cool 50% return on your cash. That's the appeal. Leverage magnifies your gains. But here's the part that too many people overlook. Leverage magnifies your losses with equal force. If that house drops in price to $450,000 and you sell immediately, you've lost 50% of your investment, and the bank still expects you to repay the full $400,000 loan. Leverage doesn't care which direction the market moves. To see why this matters so deeply in the stock market, we need to go back to the 1920s, territory that we covered in our November 15th, 2025 episode on the crash that sparked modern market regulation. During what we now call the Roaring Twenties, investors could buy stocks by putting down just 10% of the purchase price and borrowing the remaining 90%. If you had $1,000 cash in your pocket, you could control $10,000 worth of stock. And a 10% gain on that $10,000 worth of stock meant a $1,000 profit, which was a 100% return on the cash that you put up. But the math works both ways. A 10% decline wiped out your entire investment. And a decline beyond that meant that you owed your broker more than you started with. When the crash hit in October of 1929, millions of margin investors received demands to deposit more cash or sell immediately. Most folks couldn't come up with the money. Brokers sold their positions into a falling market, driving prices down further, triggering even more selling. The cascade turned a correction into one of the worst financial crises in American history. The lesson was brutal and unmistakable. Leverage without limits is a recipe for disaster. Now, the regulatory response was really swift in relative terms. The Securities and Exchange Act of 1934 gave the Federal Reserve authority to set margin requirements, and on October 1st, 1934, the Fed adopted what's called Regulation T as in Tom. Between 1934 and 1974, the Fed adjusted the initial margin requirement 23 times. But since 1974, this requirement has held steady at 50%, meaning that if you want to buy $20,000 worth of stock on margin, you have to put up at least $10,000 of your own money. In the 1920s, that same investors could have controlled $20,000 worth of stock with only $2,000. But the initial purchase is only part of the margin story. FINRA, or the Financial Industry Regulatory Authority, sets a maintenance margin requirement. This is the minimum equity that you must hold in your account at all times. FINRA's current floor is 25% of the current market value of your holdings, although many brokerages set their thresholds higher. When your equity falls below that maintenance margin level, your broker issues what's called a margin call, which is a demand to deposit more cash into your account or sell securities to cover the gap immediately. And here's what catches many investors off guard. Your broker is not required to give you advanced warning before liquidating positions to cover the call, although most brokers do give you that kind of advance notice. Now, let me walk you through a simple example of how a margin call works, because the math is what makes this real. Let's suppose that you have $10,000 in cash and borrow another $10,000 from your broker to buy $20,000 worth of stock. Your equity, what you actually own after subtracting what you owe, is $10,000 or 50% of the portfolio's value. Now, let's imagine that the stock drops 35%. Your portfolio is now worth only $13,000, but you still owe your broker $10,000. Your equity has fallen to $3,000, or just 23% of the portfolio's value. If your broker's maintenance margin is, let's say, 30%, you've fallen below the threshold and you will receive a margin call. Now, here's a really painful thing for you to note. Most brokerages require you to restore your equity all the way back up to the initial margin level, which is in this case 50%. That means that you need $6,500 in equity in your account on that now $13,000 portfolio value. So you've got to come up with an additional $3,500 in cash, or your broker will sell enough of your stock to close the gap. Here's the cruel irony I want you to sit with. Margin calls almost always arrive at the worst possible moment, when the market is falling and your losses are mounting. You're forced to sell into weakness or come up with cash you might not have, precisely when patience might be the better long-term decision. Now, what does this mean for you? Leverage is neither inherently good nor inherently bad. It is a tool, one that experienced investors use thoughtfully and one that has destroyed fortunes when used recklessly. The 1920s taught us what happens when leverage has nearly no limits. The rules that followed exist because of the wreckage that unchecked borrowing left behind. If you ever consider using margin, I want you to pause and ask yourself a few questions. Do I really understand how the math works on the way down and not just on the way up? Could I cover a margin call tomorrow morning if one arrived? Am I borrowing because I have genuine conviction about where the stock is going, or because I'm impatient and want to turn a quick profit? Would I make the same investment if I had to use only my own cash? If any of those answers give you pause, that's information worth listening to. Now, next week, we're going to zoom out and look at the broader landscape of equity risk, the different types of risk that come with owning stocks, and why understanding them is essential to making sound investment decisions. And then in the weeks ahead, we'll come back to margin and leverage from a different angle entirely. What happened in January of 2021 when a video game retailer called GameStop revealed that margin calls don't just affect individual investors, they cascade through the financial plumbing of modern markets in ways that surprised almost everyone watching that story unfold. Until next week, I wish you grace, dignity, and compassion. My name is Andy Temte. This is Money Lessons. You can find the show on all the major streaming services as well as out on YouTube. Please like, subscribe, rate, and most importantly, share this public educational good with your friends, your family, your neighbors, and maybe a colleague. The show was produced by Nick Temte, and we'll see you next time on Money Lessons.